Hello, Scott Spiker here, and this is another in the video series Real Estate Finance. In this episode, we will cover a few things to think about for experienced home buyers and those moving up to a larger home, or those actually empty nesters who may be selling a larger home and downsizing. If you have any questions regarding this process, stick around and see what surprises are in store. Welcome to our series on real estate finance, and I am joined by Austin Irwin from Directors Mortgage here today, and we are at their offices in Lake Oswego, Oregon. Austin is a member of Team Irwin, whose combined experience spans more than 40 years. They pride themselves in providing excellent, personal, tailored service to clients regardless of their budget or situation. Austin, nice to have you here today. We're going to go into experienced buyers, people that have either had a mortgage before or maybe several and are making a move at this point. So in that regard, how can you be competitive as a buyer in this area with people that are out of state, and a lot of times those are cash buyers? What are their options there to compete with a cash buyer?
That's a really great question. It's something I'm asked on a daily basis because there are a lot of out-of-state buyers that are coming into our market and are looking to purchase a home. And so that creates more demand in an already tight inventory market like you're currently seeing. So one way we can help clients that are looking to upsize, downsize, or even just make a lateral move is tapping the equity already existing in their residence with either a bridge loan or a home equity line of credit. A bridge loan is just a vessel of short-term financing to bridge the gap of that down payment from the departing to the new residence. Gives you the convenience as a client to close on the new home before listing the departing residence, like with an agent yourself, and going through that whole rigmarole. So it's a convenience factor to be able to make a non-contingent offer and stand out, because you're going to have better chances of getting that offer accepted if you're non-contingent than contingent.
Right.
Now, there's also programs that we offer called Same as Cash. Allows you to mirror cash offer as a buyer, whether you're a first-time home buyer, mover-upper, or downsizer.
Nice.
But the requirement is you have to have 20% down. So it's a little bit more money. But if you already have equity in that departing residence, we can use that to be able to mirror that cash offer, close in 10 days or less, and we don't even require an appraisal. So now we're able to compete with those cash buyers, close quick, and then once that's all said and done, we can look at refinancing and getting that client into a 30-year fixed or whatever type of mortgage they want to be.
That's great. That's great. So is there an ideal, I guess it depends on the product then, as far as an ideal down payment. Does that vary on the situation, the home they're looking at? How does that work, and is there an ideal down payment for you guys?
There's no real ideal down payment. It's all depending on what the client's motivations are and the loan program that we're using. Because if the client's upsizing and they're going from their starter home to I like to call it the big mansion or that bigger home, well, they're probably going to be looking at what's called a jumbo loan. And a jumbo loan is anything over a loan limit of $647,200 in Oregon. Okay. Loan limits differ depending on state. Okay. But if you're a jumbo loan, typically you want to see 20% down. If you're staying in the conforming loan limit, you could do as little as 3% down, up to $647,200. But really, if you have the equity in that departing residence, you want to try to use that equity as all the down or most of the down to be able to attain that new home. Makes you stand out as a buyer.
Right. And then the 647 and change that you mentioned, do you know what that is for the Washington side?
So Washington also differs, because in the Vancouver metro, Ridgefield, it's going to be $647,200.
Okay.
When you're in the Seattle metro, there's called a conforming high balance mortgage. And that is a lot larger than what we're currently seeing, because Seattle's such a higher priced market. But like I said, it's going to depend on the metropolitan city you're in.
Sure. Well, that makes absolute sense too. So, and then as far as like determining a budget for somebody, is there a way that they can sort of figure that out on their own, or is that something they should come to you with and then kind of establish from the criteria that you've that they've given you what their home shopping budget might be?
Yeah, great question. I actually just got off a phone call before we jumped into this meeting with a client that was outlining what their monthly payment, or where they wanted their monthly payment. They said $3,500 on the button or less. And they're looking to upsize, like we're talking about. Well, we identified that they had a boatload of equity in the departing residence,
Right.
and we're going to tap into it with a bridge loan. Now, they're going to do 20% down on the new home. When we penciled an $800 purchase price, the payment on it was going to be $4,500. He said, Austin, I don't want to pay $4,500. And I said, don't even worry about it. You have an additional $180,000 in equity in that departing residence that when you sell, you're going to get that after you pay real estate fees. So we're going to take that equity, and then we're going to do a principal reduction payment, and then recast your loan. That means re-amortize the loan over 30 years. You still keep the interest rate that you locked in at, and then that lowered his payment from the $4,500 to about $3,300 a month.
So essentially, they're basically applying a larger down to the property. Is that correct?
Right after they close, exactly. And we walked the client through step by step to complete that. So that's a budget talk that we had. And the budget talk spanned for your first-time homebuyers, your mover-uppers, your downsizers. But this is a budget talk that we had. How are we going to achieve that new home? And how are we going to get that payment where we want it to be? Work perfect for him and his family.
Right.
But that's a conversation that we have every time we have that mortgage consult.
Nice. Okay. And then I think we sort of touched on this a little bit, but for those that have a home that they're selling and they want to access the equity for, say, touch up the outside, paint it, give it a little more curb appeal, make the inside a little more presentable so it's competing with other properties out on the market, how can people do that, and is that allowable in the process so that they can sort of upgrade their home a little bit, make it more exciting for folks that are looking at homes?
Right. So, let's say they had the consult with you and you pointed out a few things that they want to do or that they should do to get that value higher, or at least appeal a little bit more on the curb. Well, a home equity line of credit is always my first go-to, because a home equity line of credit is going to allow you to tap into the equity that you currently have at a lower and cheaper interest rate than most other products would offer.
Right.
And a home equity line of credit is great. Typically, it's only a cost of $500 to set up. It differs on the company you work with, but it's a great way to tap the equity and then do those sprucing ups that you want to do, that either you pointed out or the client pointed out.
And then at the end, then would that would be a consideration in the new loan for their new home, right? Right?
Exactly.
So you would fold that in somehow and make that a consideration.
Exactly, because if they do a home equity line of credit, now that's included in what we call debt to income ratio. So we have to make sure that they're going to qualify for that. So we have that conversation up front, and we already planned it out in the mortgage budget.
Right. Okay. Perfect. Sounds good. And then there's fixed and there's adjustable rate mortgages, and people have some confusion over that. Where would you use one or the other? Is there a preference? And maybe you could explain that a little bit.
Yeah, fixed mortgage basically means you're going to be fixed on that principal and interest payment for 30 years, 20 years, whatever type of fixed amortization you're looking for. Whereas if you're doing an adjustable rate mortgage, or what we call in the industry an ARM, well, you're going to be fixed because ARMs depend. There's a 5-6 ARM, there's a 7-6 ARM. The ARMs depend, but it means that the ARM's going to be fixed. If you did a 5-6 ARM, 5 years fixed, and then it readjusts every 6 months moving forward.
Okay.
And you're going to move with where prime is at. And so that can be risky for clients that are looking to have a fixed payment for a long duration or on a fixed income. So ARMs are suggested when the client has a higher risk threshold, or if we know that we're going to go into a refinance situation like we potentially will in 2023 or 2024.
Right.
But for the most part, I like to play it safe because I'm a conservative guy, and I like to go with the 30-year or 20-year, whatever that fixed requirement is that the client's looking for.
Sure.
Because there's always another time to refinance.
Right.
Whereas that ARM, you might be stuck.
Yeah.
If that refinance opportunity doesn't come soon enough.
I see. Okay. Interesting. And then maybe you could go over, because this is kind of a little bit confusing for folks as well, like discount points and origination fees. How do those work? What's kind of maybe define that a little bit for folks?
Yeah, so in the last video, we talked about points when you're looking at shopping a mortgage.
Right.
And you always see online lenders post really attractive rate, but in the fine print and when you click, there's going to be discount points included. And discount points are fees that you're going to pay at closing to attain that interest rate. Origination fees are a little bit different. Because if you work with a direct local lender like myself, you don't pay an origination fee from me. There is no fee for me to collect your mortgage. Now there's a processing underwriting fee for the team, but there's no fee for me. Whereas you work for a broker, if you work with a broker, they have access to 10 different investors, but you're going to most likely pay their commission, and that's usually an origination fee. So
Right.
if you're working with a broker, you're going to pay discount points maybe to attain a lower rate and the commission, so it gets kind of costly.
Right.
That's why it's always great to work with a local lender like Directors, because, well, everything's done in the building that I'm in, and we don't broker loans.
Right. So you could end up paying discount point fees and origination fees then. That's conceivably possible.
Yes, definitely. You can look at paying both. And especially with the forecast that we're looking at in 2023 or 2024 for a lower interest rate environment, I'm not too hot on having clients pay points right now, because by the time they're going to recoup that money, and typically it really depends, but typically it's around 4 to 5 years, most likely that refinance opportunity is already going to be there before then. So that money that they spent to get that lower interest rate, they lose, because then they're going to refinance. So I'm not excited about paying points right now. I'm doing
Right.
a low cost mortgage. That's my motto right now,
Right.
so that we can get that refinance in the future.
Nice. Okay. And then in conclusion here, I guess maybe it varies on the product and such, but is there a penalty for early payoff? Say somebody wants to make double payments a month, like maybe their mortgage is due on the 30th, but they'll make a payment on the 15th and the 30th just to pay down some of the principal. Do you guys have products where they're not penalized for early payoff, or how does that work?
Yeah, at least I can speak for Directors. When you're looking at our in-house products, there is no early payoff penalty. There's no prepayment penalty.
Nice.
So the client can pay it off as quick as they want. If they want to make extra principal payments, they can. That's totally fine. There's no issue. But if you do what's called a non-qualified mortgage, which I'm not going to touch too much on, but a non-qualified mortgage, there may be a prepayment penalty. And a non-qualified mortgage means that you're outside the box, maybe income or credit. You're going to be outside the traditional box of traditional finance.
Right. Okay. So, good deal. Hey, Austin, thank you again for being here in this series. We'll talk to you some more here in a second. But folks, stick around. We'll have some more on real estate and finance in the next issue of Cascade Living.